Ladies and gentlemen, on behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to a research webinar on our manufacturing sector stock picks. Capital Trust Securities is ranked number 1 during the first half of the year 2021 in terms of transaction turnover and brokerage turnover. Capital Trust Securities is also ranked number 1 in the first 9 months of the financial year 2021-2022 in terms of transaction turnover, brokerage turnover, and number of transactions. Today's webinar is the 19th of a continuous series of webinars. Capital Trust Research Private Limited has been at the forefront in correctly identifying early and recommending stocks through its webinars and comprehensive research reports. These efforts have generated significant outperformance for investors during pandemic conditions. We are happy to see that we have guided numerous clients to make enormous returns and kept the Colombo Stock Exchange very active. Today's webinar on manufacturing sector stock picks will cover ACL, RCL, LWL, and TILE. Now I'm pleased to introduce Mr. Hasitha Liyanage, Head of Research of Capital Trust Research Private Limited, and Mrs. Divya Kasichetty, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentations. You may type any questions you may have in the chat, and we will answer questions which are relevant to many.
Thanks, Prashani. Capital Trust Research has done detailed analysis of over 30 companies in the last 1 year. However, Capital Trust Research decided to release research reports and conduct webinars only on a select few so far. The reason for this is many companies refuse to give research meetings, and even when they do give a research meeting, they do not provide sufficient data in order for us to prepare meaningful and reliable forecasts. Further, we believe that many companies which mirror the performance of the Sri Lankan economy have still not recovered from the pandemic. And therefore, we have decided not to publish research reports of those companies too. However, Acl Cables PLC, which we had identified as a potential investable stock for a few months, has finally qualified to be included as a Capital Trust stock pick of the manufacturing sector. Acl Cables manufactures electric cables, switches, and accessories, and holds approximately 70% of the dealer market share and 75% market share of the institutional market. Group's product range includes power cables and conductors, armored cables, aerial bundle cables, control cables, telephone cables, and auto cables. Let's take a quick look at the group structure. Acl owns 79.3% of Acl Cables, who are involved in the manufacturing and selling of power cables, telecommunication cables, and enameled winding wires. Approximately 65% of Acl Plastics and Acl Polymers are held by Acl Cables. Acl Plastics are involved in the manufacturing of plastic and PVC compounds. Fully owned subsidiaries Acl Metal and Alloys is involved in manufacturing of aluminium and aluminium alloy rods. Ceylon Copper Private Limited is involved in manufacturing of copper rods, bus bar strips, and Acl Electric Private Limited is involved in manufacturing of electrical accessories, including switches, sockets, and breakers. Acl Kalani Magnet, a 93.79% owned subsidiary, is involved in manufacture and export of enameled winding wires. Acl acquired 51% of Cable Solutions Private Limited in November 2019. This acquisition resulted in an expansion of Acl's product range and enables Acl Group to further improve marketing capabilities and access untapped markets, including Europe and US. The company is also the single largest shareholder with a 32.5% shareholding in Resus Energy, one of the major hydropower generating companies in Sri Lanka. Fully owned subsidiary Lanka Acl Cables is an investment company. The local cable market size is approximately 29 billion rupees. Industry consolidation has been witnessed during the last few years, and currently the key players within the sector are ACL, Kalani, Sierra, and Orange. Of the total market, approximately 52% is the dealer market. 28% caters to the private companies and 21% to the government sector, which mainly includes Ceylon Electricity Board. Let's have a look at the dealer market. Within this space, ACL Group holds approximately 70% market share, where they operate through 7,000 dealers island-wide. The other players operating within this segment includes Sierra Cables, Orange, Sun Cables, SR, and Ruhunu. The dealer market does not rely on imported products. Therefore, ACL Group is not expected to be adversely impacted on this segment if the current import bans on cables are lifted. The strict import controls implemented has, however, positively impacted the local manufacturers as smuggled cables are not available. Moving on to the institutional market, the group holds approximately 75% market share. Sierra Cables and Orange also operate within this segment. ACL Group serves key government institutions, including CEB, Lanka Electricity Company, Railways, and Sri Lanka Telecom. Among the private companies, the group has supplied to some key projects, including Cinnamon Life, Colombo City Centre, Grand Hyatt Colombo, Altair, Astoria, and Love Solar Panel Terminal, Hambantota. The local cable manufacturers, including ACL, are beneficiaries of the import ban. Previously, among state-owned institutions, CEB was allowed to import cables at duty-free pricing. Further, certain foreign projects registered with the BOI were granted permission to import cable when the required type was not available in Sri Lanka. ACL supplied 80% of the requirements of duty-free projects owned by overseas investors and approved by the Board of Investment. In financial year 18, the industry saw a tendency towards relaxation of the negative list for some free trade agreements. However, since then, the industry lobbied to the government to keep cables in the negative list, even for free trade agreements, and have succeeded. At present, cables remain to be on the BOI negative list, providing an opportunity to the local manufacturers to supply the product for these projects. Revival of the construction and real estate industry will also support cable industry growth. In addition to the above, the dominant market position of ACL Group across all segments enables the group to drive price increases as and when the need arises and ensure that their margins are maintained. As reflected in the graph, the construction and real estate industries witnessed a recovery from third quarter 2020 onwards. ACL Group revenue mirrored this trend. Although ACL was adversely impacted in the first half of 2020 due to COVID-19, it has recorded steady revenue growth from third quarter 2020 onwards. ACL Group is the main cable supplier to all government projects and is expected to record strong performance over the next 2 years, backed by the ongoing construction and infrastructure development drive. Number of building approvals, even during the pandemic period, was recorded at 8,969 within Greater Colombo. This signals a steady revenue stream for the sector, considering the ongoing construction and maintenance work. Now let's have a look at the raw material prices and its forward outlook. Imported raw materials such as copper, aluminium, and PVC amount to majority of ACL's cost of sales. Copper grew 17.44% year-on-year in financial year 21 and by a significant 65.74% year-on-year during April to August 2021. This was mainly driven by higher demand from leading consumer China, given the economic recovery post-vaccine rollout. However, the price declined in July and August 2021 amid concerns of slower growth in China and rising COVID-19 cases globally. Copper prices are expected to remain high, however, will come under pressure in the second half of the year owing to the slowdown in the Chinese economy. Further, troubles with the mine supply is also expected to ease this year, which will exert downward pressure on copper prices. Aluminium prices rose 56.17% year-on-year on average during April to August 2021. The rise in aluminium prices is a result of high demand in China and growing concerns that China's new climate policy, which focuses on greenhouse gas emission reduction, could limit future supply of the metal. Steadily increasing demand could see the global aluminium market tighten into a deficit. Aluminium prices are expected to remain high for the rest of the year. Acl imports majority of their raw material as availability of scrap metal is limited, and there is a ban on importing scrap unless for export purposes. The company does not book contracts in advance and therefore is largely dependent on prevailing prices. We expect the declining copper prices to positively impact the margins, as it is unlikely that the company will immediately pass on the benefit to the end consumer. Given its dominant market position, Acl is able to determine prices and has the ability to pass on the higher cost of raw materials to the end consumer, as and when the need arises. From November 2020 to August 2021, 4 upward price revisions were carried out. A further price increase of 10% came into effect in September 2021. Looking back at the last year, gross profit margins declined from 17.06% in financial year 20 to 16.98% in financial year 21. This was mainly led by 17.4% year-on-year increase in average global copper prices and an increase in aluminium prices. Further, the exchange rate depreciated 5.52% during financial year 21, which adversely impacted their cost of sales. As discussed previously, copper and aluminium prices were volatile and increased significantly during the first quarter of financial year 22. In terms of cost of goods sold, energy costs are negligible, as the company has invested 400 million rupees in solar. The energy cost is estimated at 10 million rupees per month, and the company uses both gas and furnace oil when required. As a result of the price increases, along with the increased capacity utilization at the factories, we expect gross profit margins to be maintained at 16.33% levels over financial year 22 and 23. We believe that the gross margins can be sustained at these levels, as Acl is likely to pass on any cost increases to the end consumer, similar to financial year 21. Further, Acl expects to improve its product mix through increasing high value-added product sales, which would support margins. Acl's revenue recorded a CAGR of 8.39% during financial year 17 through to financial year 20, despite a marginal growth in GDP of both construction and real estate activities during this period. Financial year 21 saw revenue growth of 21.07% year-on-year to 22.62 billion rupees. First quarter financial year 22 recorded an impressive 95.93% growth year-on-year, although from a low base, owing to the disruptions caused by the pandemic in the corresponding period of the previous year. The 2.58% quarter-on-quarter dip in the first quarter of financial year 22 revenue is attributable to COVID-19 led lockdowns. First quarter is also generally a relatively slow quarter for the companies within the building materials sector due to the Sinhala and Tamil New Year holidays in Sri Lanka. When looking at the graph historically too, this trend is evident, where each quarter performs better than the previous. Looking at the revenue mix in financial year 21, 82.4% is from local sales, with the balance being exports. Local revenue grew at 5.46% CAGR in financial year 17 through to financial year 20 and recorded strong growth of 23.44% year on year to 18.64 billion rupees in financial year 21. This was led by strong volume growth in the dealer market and project market segments, coupled with higher average selling prices. In line with its strategy to focus on the electrical segment, switches, including its low voltage switch series, miniature circuit breakers range, recorded a significant growth year on year. Export revenue grew at a higher pace, at a 25.88% CAGR in financial year 17 through to financial year 20, and recorded 11.09% year-on-year growth in financial year 21. The revenue contribution from exports increased from 12.23% in financial year 17 to 17.57% in financial year 21, which further increased to 22.33% in the first quarter of financial year 22. Net borrowings increased by 2.63 billion rupees quarter on quarter, primarily for inventory and working capital. During the first quarter of financial year 22, capital expenditure was recorded at 163.97 million rupees. This was in order to gear up towards building up capacity with modernized machinery to cater to the dealer market and ACL's project pipeline. We expect revenue growth of 40% year on year in financial year 22 and 11.6% year on year in financial year 23. This is supported by the expected capacity increase brought about through acquiring and modernizing Acl Cables machinery. The additional capacity is expected to be available from the second half of financial year 22 onwards and is expected to support expansion within the dealer market capacity by 50%. The increase in capacity is mainly expected in the dealer market of ACL and the power cable segment at Acl Cables. Revenue growth is expected to be further supported by the steady project pipeline. This includes CEV projects, Bandar Naik International Airport Terminal 2 development project, Cinnamon Life, and Colombo Port City projects. In addition to the projects and growth in dealer market, the price increases supplemented from November 2020 onwards, which amounted to over 50% year on year, will further support revenue growth. ACL is also expected to benefit through synergies from Cable Solutions Private Limited, which was acquired in November 2019. The group expects to use its marketing strength to capture untapped export markets, including Europe and USA. The export segment is currently battling the challenge of higher freight rates to selected markets. However, efforts are underway to expand its reach to new markets, including Malaysia and Indonesia, with niche products in addition to its key export markets, Bangladesh and Maldives. Considering the current operating environment, ACL is looking at ways of strengthening its working capital cycle and pushing for sales on a cash upfront basis, especially in the dealer market. Further, the company holds sufficient raw materials for the short term, and its strong financial position, including the USD reserves, are expected to be utilized to mitigate any adverse impact from importing raw materials. We have projected revenue to be recorded at 31.68 billion rupees in financial year 22 and 35.36 billion rupees in financial year 23. Going forward, we expect ACL's revenue mix to be 35% to the dealer market, 25% to the government sector, 25% to private companies, and 15% to exports. Considering what we discussed, and effective management of operational costs are expected to result in recurring operating profit growth of 50.9% year-on-year in financial year 22 and 15.87% year-on-year in financial year 23. Recurring operating profit margins are expected to be 9.28% and 9.64% in financial year 22 and 23 respectively, versus 8.62% in financial year 21. Share of profit from associate grew at 14.44% CAGR in financial year 16 through to 21 to 107.43 million rupees and is expected to bring in a steady contribution to ACL's profitability in financial year 22 and 23. This reflects ACL's 32.53% shareholding in Resus Energy. Resus has a strong project pipeline with 2 megawatts of hydropower at an investment of 700 million rupees, which is nearing completion, and 12 megawatts of solar power plants, where development is expected to commence in financial year 22 at an estimated cost of 2 billion rupees. After these projects are operational, the company's portfolio is expected to see a significant increase in solar power capacity, where the hydro and solar capacity would stand at 15.6 megawatts and 14 megawatts respectively. ACL's growth story is backed by its market-leading position and established track record of catering to large-scale projects, including CEB projects and majority of the high-rise residential apartments in Colombo. Further, timely in-house capacity additions and inorganic growth, including recent acquisitions, also expected to strengthen earnings. Strong volume growth with a steady order book and multiple average selling price increases implemented in the second half of financial year 21 and first half of financial year 22 is also expected to boost earnings in financial year 22 and 23. The current regulatory environment where imports of cables are restricted also impacts ACL favorably. Considering the factors previously discussed, the recurring net profit attributable to equity holders is forecasted at 1.74 billion rupees in financial year 22 and 2.07 billion rupees in financial year 23. Moving on to the valuations, ACL is currently undervalued and is trading at a PE of 6.86 times financial year 22 forecasted earnings and 5.76 times financial year 23 forecasted earnings respectively, and trading at a PBV of 0.83 times financial year 22 forecasted earnings. Considering an expected dividend payout of 35.29%, dividend yields are at 5.14% in financial year 22 and an attractive 6.13% in financial year 23. The group announced a 2-for-1 share subdivision, which came into effect from February 2021 and improved the liquidity of the counter. We expect the company to trade at 10 times financial year 22 forecasted earnings. This has been arrived at considering its dominant position in the market and against other peers within the building material sector. Accordingly, we assign a fair value of 72 rupees and 60 cents, which provides a 46% upside on this count. I will now hand over to Hassan.
Thanks, Divya, for the detailed presentation on ACL. Now let's move on to the other leading segment in the manufacturing sector, the tile sector. We have spoken to the dealers and showrooms of Lanka Tile and Rosell, as well as company management. We understand that there is a material change in the operating environment in terms of sales and margin of RCL, LWL, and tile compared to our previous forecast for Q2 financial year 22 and the second half of financial year 22. As a result, we have decided to carry out today's webinar with an update on the tile sector. As per discussions with dealers and showrooms, we were notified that sales and pre-orders generated across RCL, LWL, and tile were unaffected by the lockdown. The pre-order pipeline remains strong despite the recent lockdowns. The company's sales continue to be above production capabilities, resulting in pre-order sales wait list increasing from 10 weeks to 12 weeks over the quarter. As mentioned previously, the import ban on tiles continues. Given the forex reserves are at close to an all-time low, we don't expect the import ban to be removed in the near future. Current government initiatives support local manufacturers to cater to entire Sri Lankan demand. In the very unlikely event of restrictions being relaxed, competition from imports are expected to remain immaterial, as the cess on tiles was increased from 50% or 183 rupees per square meter to 50% or 490 rupees per square meter, whatever is greater. This methodology of duties and cess eliminates under-invoicing and creates a fairer playing field for local manufacturers. With the depreciation of the LKR and freight costs hitting an all-time high, landed costs of imported tiles are expected to be much higher than locally manufactured products. As a result, imports won't be price competitive, enabling local manufacturers to sell whatever products produced. Prior to the import ban, 48% of the market was catered to by importers. After the implementation of the import ban, local manufacturers are expected to cater to 100% of demand, creating a huge demand-supply mismatch. The RCL Group pre-orders have increased from 10 weeks to 12 weeks, as said before. Locally manufactured tiles will continue to be more price competitive, and in the very unlikely event when the import ban is relaxed, it will increase its competitiveness. This provides an opportunity for local players to expand production capabilities and cater to the entire local demand in future years. The RCL Group has already planned capacity expansions across RCL, LWL, and tile over the calendar year 2022. RCL will be increasing capacity at its Corona plant by adding another 3,000 square meters a day of capacity. The new capacity is expected to come online in June 2022. LWL is expected to add 5,500 square meters a day of new capacity in the calendar year 2022 across two phases. The first phase of 1,500 square meters a day is expected to come online in June 2022. The second phase of 4,000 square meters a day is expected to come online in December 2022. Tile is expected to increase its production by 1,200 square meters a day by June 2022. After the implementation of these capacity expansions, the local manufacturers comprising of mainly the RCL Group and Maxons will be in a position to cater to the entire local demand by the end of calendar year 2022. As we all know, there is a shortage of USD in the banking system at present. Local manufacturers are having difficulties in opening LCs for raw materials if they do not have sufficient dollar deposits. This is an issue faced by most local manufacturers, and there are fears that the RCL Group is currently facing the same challenge. Currently, the RCL Group generates USD inflows through export earnings from its Mosaic tile operation that is running at full capacity. The RCL Group had LKR 604 million in equivalent USD term deposits as of 31st March 2021 and has increased further in financial year 2022. It is important to note that with adequate USD reserves in place, management have not faced any difficulties in opening LCs for the importation of raw materials. It is also important to note that the main raw material used by the tile sector is clay. This is sourced from companies' own mines and well-established supply networks. The RCL group is exposed to currency risk with regards to importation of raw materials such as LPG, aluminium, packing material, and sanitary ware accessories. With the depreciation of the LKR, the price of such materials have increased. The company management is concentrating on cutting down its reject rates and optimizing its production process to increase cost savings and offset the impact of increase in the cost of raw materials. In addition, the capacity expansion, management are expected to use cutting-edge technology that will bring about improved production efficiency. Management also strategically sourcing raw materials at low price points to offset increases in exchange rate. According to indications from distributors and showrooms of Lanka Tile and RCL, as well as discussions with company management, we expect tile sector stocks to outperform our previous expectations for Q2 financial year 2022 and the second half of financial year 2022. During our discussions, we noted that the RCL group has a strong order book, and despite the recent lockdowns, pre-orders and waiting lists for tiles have increased from 10 to 12 weeks during the lockdown period. We expect group margins to strengthen during the second quarter and the second half of financial year 2022, as the management have changed the business model to improve its sales mix across more profitable, larger tile segments. Post-capacity expansion at the end of calendar year 2022, we expect the group to expand its range of high-value exports. As you can see in these graphs, 1Q has historically been the worst performing quarter for the sector. This is expected as the Sinhalese and Tamil New Year holidays and other holidays disrupting construction work in April each year. In the past, profitability across RCL, LWL, and tile increased quarter on quarter from 2Q to 4Q. This trend is expected to continue in FY22 and FY23. It is important to note that we have revised our earnings for 2Q financial 2022 and future periods across all three companies as they continue to outperform our earnings expectations. We have revised 2Q FY22 net earnings to equity holders by 16.3% for RCL, 21.3% for LWL, and 28% for tile. As shown in our previous slide, cyclically, Q3 and Q4 are the best performing quarters for the tile sector. As a result, we have updated our forecast for second half of financial year 2022 and 23 as well to reflect the improved operating environment. We have revised up RCL's FY22 forecast and net earnings to equity holders by 9.7% to LKR 7.31 billion. We have revised up LWL's earnings by 11% to 3.44 billion. We have revised up tiles earnings by 14.7% to LKR 3.18 billion. These will have material impact on the fair values of all three companies. As mentioned before, due to the improved operating environment at present and the capex expansions expected to kick in by 2Q FY23, we forecast a 13.5% increase in revenue on a year-on-year basis in financial year 2022 to 51.06 billion, and a 10.1% growth in revenue in FY23 to 56.2 billion. Profits attributable to equity holders forecasted at 7.31 billion in FY22 and 7.95 billion in FY23. Given the 40% dividend payout ratio, we forecast a 5.43 and a 5.91 dividend yields in FY22 and FY23 respectively. With the change in projected revenue and change in operating environment, we have revised up earnings forecast by 9.7% for FY22 and 7.4% in FY23, considering the ongoing yield management strategies and the expected increase in production capacities in financial year 23. As mentioned before, we increased our forecast for 2Q FY22 by 16.3% compared to our previous forecast. RCL is currently trading at a very attractive PER of 7.37 times FY22 forecast and 6.77 times FY23 forecast, respectively. With the market PER increasing from 10 times in the recent past to 11.67 as of the 15th of October, we have revised the target PER of RCL from 11 to 11 from the previous 10, which is still below the market PER. Thus, we have upgraded RCL's fair value to 72.6 rupees a share, which is 49% upside to the current trading price. This is based on a PER of 11 times FY22 forecasted earnings. We are of the view that the PER of 11x is justifiable based on the expected robust earnings growth and the expansion capacity expected in financial year 23. As mentioned before, due to the improved operating environment at present and the capex expansions expected to kick in by 2Q financial year 23, we forecast a 13% increase in revenue on a year-on-year basis in financial year 22 to LKR 33.2 billion and a 9.4% growth in revenue in financial year 23 to LKR 36.4 billion. Profits attributable to equity holders forecasted at 3.44 billion in financial year 22 and 3.95 billion in financial year 23. It's important to note that the 4,000 square foot expansion part of phase 2 has not been incorporated in our financial projections for LWL in financial year 23. Given the 40% dividend payout ratio, we forecast very attractive 6.62% and 7.61% dividend yields in financial year 22 and financial year 23 respectively. With the change in projected revenue and the change in the operating environment, we have revised up earnings forecast by 11% for financial year 22 and by 9.1% for financial year 23, considering the ongoing yield management strategies. As mentioned before, we have increased our forecast for 2Q financial year 22 by 21.3% compared to our previous forecast. LWL is currently trading at a very attractive 6.04 times FY22 earnings and 5.26 times FY23 PER respectively. Similar to RCL, we have revised the target PER of LWL to 10 times from the previous 9 times due to the increase in the broader market PERs. Thus, we have upgraded LWL's fair value to 126 with an upside of 66% to the current trading price, based on a PER of 10 times FY22 earnings forecast. We are of the view that the PER of 10x is justified based on the expected earnings growth and the expansion in capacity expected in financial year 23. Due to the improved operating environment at present and the capex expansions expected to kick in by the 2Q FY23, We forecast a 12.7% increase in revenue on a year-on-year basis in financial year 22 and a 14.2 billion and 9.7% growth in revenue in financial year 23 to 15.6 billion. Profits attributable to equity holders forecasted at 3.18 billion in FY22 and 3.53 billion in FY23. Given the 40% dividend payout ratio, we forecast a 6.44 and an attractive 7.15% dividend yield in financial year 22 and financial year 23 respectively. With the change in projected revenues and change in operating environment, we have revised earnings forecast by 14.7% for financial year 22 and 9.8% in financial year 23, considering the ongoing yield management strategies and the expected increase in production. As mentioned before, we have increased our forecast for 2Q FY22 by 28%. Tile is currently trading at a very attractive 6.21 times FY22 forecast and 5.6 times FY23 forecast respectively. Similar to LWL, we have revised the applicable PER of Tile to 10x from the previous 9 times due to the increase in the more broader market PER. Thus, we have upgraded Tile's fair value to 120 with an upside of 61% to the current trading price, based on the PER of 10 times financial year 22 forecast. We are again of the view that the PER of 10 times is justified based on the expected robust growth in earnings and the expansion capacity is expected to come online in financial year 23. Thank you, Prashant. Thank you, everyone. And over to you, Prashant.
We thank you, Hasita, Divya, and the research division for their valuable insight on the manufacturing sector stock picks. Now, can Mr. Shehan Mendes, Assistant General Manager of Capital Trust Securities, will read out some of the questions that are relevant to many clients which have been sent to the chat by the audience, please.
Good morning, ladies and gentlemen. Thank you for participating. Thank you for joining with us on this webinar on manufacturing sector stock picks. And thank you, Divya and Hasita, for the wonderful presentations done on the companies. So we would like to now open the floor for the questions that any concerns that you all would like to clarify with us. I'll be happy to take them up with Divya and Hasita. So before I go into any of the company questions on any of the companies, as a break, I would like to ask a question, very reasonable question on the interest rates. As you may have noticed, the interest rates have been, the bond rates have been picking up, and at the recent T-bill auction, nearly 90 basis points, the T-bill rates also went up. To the policy rates were unchanged, but is there a it's a very genuine concern that the investors would have when the rates are rising? Will funds start flowing out of the market? Will people start moving from equity to fixed income? Would you like to clarify on that thought, Divya and Hasita?
Sure, Shehan. Actually, it's a very relevant question. We have seen an upward movement in rates at the T-bill and T-bond auctions as well in the recent weeks. So in the auction held, I think on the 12th of October, the 2-year maturity bond rose up about 124 basis points to about 9.36%. And I think the 5-year bond to 11.14% and bonds ending 2032 to 11.23%. So in the auction held on the 13th of October, 3-month T-bill yields were up by about 89 basis points to 8.04%. But the government gave a signal that it has no requirement to borrow at excessive rates, as both 6 months and 12 months bids were not accepted at this auction. Then on the 14th of October, policy rates were left unchanged, which also gives the signal that the government does not want to increase interest rates. Now let's have a quick look at this graph. So as reflected in this graph, even though there's a trend in the movement of the average weighted fixed deposit rates, and that they actually mirror the T-bill rates, there is a time lag where the AWFTR moves at a slower pace. Let's have a look at the next slide. So as reflected in this slide, at present, the average weighted fixed deposit rate is at 5.64%. The rate applicable net of taxes, assuming a personal tax rate of 18% on deposits, amounts to 4.62%. So we'll have a look at this slide. Shows you the headline inflation rate, CCPI year-on-year change, which is 5.7% in September. So the average weighted fixed deposit rate net of tax will give you a return of 4.6%. So therefore, giving you an overall negative real return of 1.1%. However, the market rate of inflation is expected to be significantly higher than this, and therefore the negative real returns are expected to be even higher. Inflationary pressure can be expected in the short term, given the rising of commodity prices and maximum retail price removals also on certain essential commodities. In light of same and central bank's indication of holding policy rates at present levels, we think it is unlikely that there will be an improvement in real returns. So accordingly, we think individuals require a real return in excess of at least 6 to 7%. Therefore, it is highly unlikely that we should see funds flowing out of the stock market into fixed deposits, especially among our clients who have generated significant, sometimes even triple-digit returns with margin trading. So even if, for example, even if margin trading costs increase by, say, 3%, the total returns on selected stocks far outweigh the returns on fixed deposits at this point in time. So essentially, to answer your question, Shehan, we don't actually see funds flowing out of the stock market at this point in time or in the near future.
Very clear, Divya. So in a nutshell, I think in fixed income, the deposit return net of tax cannot still outperform the inflation rate, and the real returns will be still negative. Plus, the equity returns are still far ahead of any fixed income returns, isn't it? So yeah. So moving on to some of the specific questions that have come up on the companies. There's a question from Fazlin. The question is, will you be able to disclose the method you have used to calculate the fair value of ACL's share price?
Sure. So Shehan, we have actually looked at the sort of peers that are trading in the building materials sector. Okay, and we have looked at ACL's position in the market. They have a very dominant position in the market with over 70% market share in the dealer market, 75% market share in the institutional market. And also, as sort of proven even in the last year, they are able to determine price and pass on that price increase. So they're actually a price maker in the market as well. So based on that, we have assigned a 10 times PER, which is still, and that is based on financial year 22 earnings. And that is still a discount actually to the overall market PER, which is at the moment about 11.7 times. So the basis for ACL, how we have arrived at the fair value of 72 rupees and 60 cents is based on a PER of 10 times on 22 forecasted earnings.
And just adding to what Divya said, on the PERs, again, it's a discount to the broader market PE. So it is relatively conservative on that basis. But at the same time, given the robust earnings growth, especially coming from the capacity expansion to the acquisition of the Acl Cables machinery and the market leading positioning, we feel that the valuations are justified, and especially on the multiples. And even on the margins, I think we have assumed conservative margins given the ability to increase price. And especially in this quarter, we expect strong performance given that the copper prices did ease off globally, whereas there was a price increase that kicked in as well. So margins should be might be higher than what we have assumed in our financial projections.
There's a question from Savit. I believe this must be relating to the tile companies. Is there a loss in productivity or wastage to machinery or any other drawback in switching to kerosene for the manufacturing energy requirement?
It might be relating to actually ACL because they use both LPG as well as furnace oil for the production process. But as Divya mentioned in the presentation, I think the energy costs are negligible, which amounts to less than 10 million a month. So I don't think they switch from LPG to kerosene based on cost factors as such. They will utilize whatever fuel source that will optimize production. So I don't think that is relevant as such in terms of switch and the losses.
Okay. Just coming back to the tile sector, an overall question, I think you made a note on this at the start also. Since the tile sector, it's a sector that we've been covering, what basically motivated you all to come up with another forecast on the tile sector, especially when we have covered it earlier?
I'm sure that's something on everyone's mind at the moment. But as you can expect, our research universe, we monitor it on a monthly basis to see exactly how the counters are performing on an ongoing basis. So we do that with touching various stakeholders, sort of management, or in terms of RCL and the other tile companies. We touch base with various dealers and showrooms. So what we found out was actually that even with the 2-month lockdown, the sales actually the waiting list actually grew, and the sales were very strong, as well as there was a shift in the product mix, as we said before, where they're moving towards the larger tiles, which are more profitable. So when we noticed that and updated our assumptions, as well as spoke to company management, we realized, yes, they're actually outperforming our conservative assumptions in terms of Q2 performance, as well as the expectations for the second half of the year. So that was the reason that we want to do the webinar, is to actually upgrade our forecast and just explain exactly where we stand in terms of earnings forecast. At the same time, even in terms of the multiples, we have seen the broader market, the multiples increase from 10 times to 11.67 as of yesterday. So previously we assumed a discount when we assigned a valuation multiple of 10 times to RCL and 9 times for LWL and tile, given the market positioning, when the market is trading at a slightly higher multiple. So this time we revised our earnings multiples as well, given the broad market multiples have expanded. So there were 2 updates of sorts that we wanted to bring into our fair value calculations.
Yeah, just to add to that, Shahan, as Hasita mentioned, we continuously monitor actually all the counters that we cover. We cover over 30 counters, and we continuously monitor it on an ongoing basis. So with regard to the tile sector, these developments in terms of how they have performed even during the lockdown, like Hasita mentioned, we spoke to multiple touch points, management as well as dealer market and so on, and we we identified that, okay, look, there's almost like a 10 to 12 sort of week waiting list, and the demand is extremely strong. Other than that, they have also firmed up certain expansion plans. So all of that, we wanted to capture and give you sort of that timely information. Also, as markets, the broader market multiple also has sort of increased. We needed to re-rate these counters, looking at the earning potential of financial year 22 as well as financial year 23.
So it's a very good message that that probably came to me was that it's not simply just giving a fair value and just forgetting about it. You all keep in touch with the management, and basically if there is upward revision or probably even a downward revision, if it's necessary, anytime we will be, as a research unit, will be we can expect that you all will be upgrading the targets accordingly. So another question on there's a on the fair valuations. There's another question from Saroja. These fair value predictions, is it for long term, as in 2022, 2023, or is it medium term?
So the fair value prediction on ACL, what we have looked at is financial year 22 forecasted earnings. So that is, that is where we actually, that is how we have arrived at a fair value. So you're looking at about a 9 month sort of outlook, and if at all financial year 23, as we discussed in our presentation, would be, sort of even stronger and even better. I think similar sort of methodology has been followed for the tile sector companies as well.
Okay, there's a question from Murtaza. It's a question, actually, the concern that I also actually had. Have you considered the impact on tile sector with recent spike in global energy costs?
Yes, so actually since December last year, LPG prices have been on an upward trend. And what's important to note, I think we covered this on other webinars as well with regards to tile sector. Industrial players don't, there's no actual price cap on LPG gas for industrial players, for bulk consumers like residential consumers, right? So they have been experiencing high LPG costs for the last so many quarters. That's why they're concentrating on various cost efficiencies in terms of reductions, optimizing the whole production process to look at various cost cutting measures. So I think they have achieved around 500 to 700 billion of cost reductions through these initiatives over the financial year last year, as well as they're looking at similar numbers this year. So yes, we have accounted for the increasing COGS as a result of higher energy prices, but this is offset to some extent through the cost-cutting initiatives management is concentrating.
Yeah. Also, from I think the margins are sustainable because from a revenue element as well, they have moved to sort of high value-added products. I think larger tiles as well. So looking at it, they're working both on cost efficiencies as well as sort of revenue improvement. So we don't see margins deteriorating. We actually expect margins to remain the same or even strengthen.
Yeah, just adding to that again, I think if you look at our second quarter revisions, it was between 14 and 28% based on the second quarter performance and sales that we've identified with the various touch points. But if you look at the total year, for the second half of the year, our revisions are much lower. We're taking a conservative approach on that. So in the once we touch base again with the with our touch points over the next few months, we will discuss and upgrade our earnings forecast if necessary, or downgrade it depending on company performance in the future.
Divya, since we touched upon the energy cost with regard to the tile sector. Would you like to explain something on the on ACL as well? Because since copper prices have hit a 5-year high recently, what type of a how well the company will be able to manage this cost escalations?
Right. Okay. So actually, Shehan, if you look at the last year, right, they were able to increase prices, on 5 times, and the latest one actually being even in September, they managed to increase pricing by about 10%. So I think on collectively, all when you look at all 5 occasions, I think roughly they've managed to increase prices by about 50%. So I mean, ACL Group, like I mentioned before, they're actually able to drive prices and increase them if the need arises. So if their input costs, raw material costs and cost of copper and aluminium actually escalate, they're able to pass that on to the end consumer, especially in this environment. Also saying that, Shehan, actually the outlook, even though copper is expected to remain elevated, the outlook is actually for it to come off slightly during the second half of the year. So that also should positively impact the company, because it's unlikely that they would pass on that benefit immediately to the consumers. There could be a time lag associated with that.
Just adding to that, as Divya mentioned, since they have a 75% market share and the other players 70 to 75% in different categories, other players being smaller, they have the ability to either to dictate price and various other terms and conditions to the buyers, etc. Whereas if there are 2 similar sized players, you can't do that, because there'll be price competition of sorts. So this is something that holds forth both for ACL as well as the RCL group in terms of tiles. They can dictate pricing if necessary and ensure the margins are sustainable. And if there are increase in COGS, they can obviously increase price to maintain margins.
Yeah. Now, Hasida, as we know, at the moment, the tile sector is benefiting from an import restriction which is going on. So, say if someday, few months down the line, if tourism picks up and if we keep getting dollar inflows into the country, and definitely the government will want to lift this import restriction. So, in that case, what type of a impact? What is the effect? Will it be a positive effect or will it be a negative effect for the tile companies if the import restriction is lifted?
So yes, as we touched upon it in our presentation, I think it's very unlikely that the import restrictions will be lifted anytime soon. If we look at the unlikely scenario of the import ban being lifted, there are some other protection in place in terms of increased duties and cess for local manufacturers. The cess was increased from 50% of 183 rupees a square meter to 50% of 490 rupees a square meter. Just considerable increase. So just with that element, that will price out most of the imports, and the local manufacturers will have a significant price advantage. So I think this was something that local manufacturers were canvassing for before they embarked on this whole capacity expansion drive. So once they got that increase, canvas and obtained that increase, they looked at implementing the capacity expansion. So I think they're quite comfortable with where they stand in terms of that aspect and the protection. Going forward, even if the import ban is lifted, we don't see them see the sales coming off or the competitive nature of the locally manufactured tiles reducing. So they'll be able to sell whatever they produce even in the future.
Also to add to that, Shehan, they have built relationships actually with some of the larger importers, and they do manufacture, under their brands as well. So they have built relationships, and I think, those are sort of long-term contracts as well. Also, the other element to also keep in mind is, higher freight costs, things like that also may make imports more expensive. And give that edge as well to the local manufacturers.
Yeah, there was an important note that at the very start you mentioned about how a stock qualifies to become to be researched by Capital Trust. Some of the a lot of people ask this question: why you all are not covering certain? I don't want to name certain sectors, but why are you all not covering these stocks, or why you all are not covering certain sectors? Would you like to enlighten us on basically what are the prerequisites probably we are looking at when we are trying to qualify a particular account or an industry?
Yeah, just I think Divya mentioned that at the start of our presentation, but as it's evident looking at our coverage and how we look at each product line, each subsidiary on a monthly basis, it's important that we have sufficient data to be comfortable and confident of our projections. So this is very important. Even if we are initiating coverage on a counter, we need sufficient information on the market, the company's position in the market, production capabilities, what's happening in the future, what are the future plans. We go through a rigorous process, and we have a questionnaire which is around 30 to 50 questions that we discuss with management even before we start building our financial projections. So if that information is not available at the start itself, we are not really confident in putting out our recommendations. So that is the process we follow. And even after that, it's imperative that we have obviously not information that's confidential or whatever, but have touch points with management on an ongoing basis to see, okay, how the companies are performing. So we actually require that for us to consider expanding on our coverage. And once we build our financial models, then we look at, okay, what are the valuations like in the future, what it looks like in financial year 22 and 23. If the valuations aren't attractive and below some of the counters that we are already included in our coverage, then we don't really release these reports or include in our coverage straight away. But if that changes in the future and the valuations do become attractive, then we will initiate our coverage and include it in the coverage universe.
Yeah. So Shehan, actually, as Hasita mentioned, we do cover, a significant range of stocks, and we do that actually on a monthly basis. But I think reliability of information and reliability of forecast is something that we take very seriously, and we go into a lot of detail and depth when we do this research. So only when we're comfortable in terms of the reliability of that and when the valuations are attractive, do we actually publish it. But saying that, we do cover a diverse range of stocks and sectors. Also, another thing is certain sectors and certain companies actually, their performance is mirroring the Sri Lankan economy at present and hasn't really recovered from the pandemic. So we're keeping a close eye on them, and we are monitoring them and gathering as much information as possible. And when the time is right and we see recovery at that point in time, we will comment on those sectors and those companies.
Yeah, so that's a very important message that I think most of our investors would also appreciate, that we take a lot of responsibility in what we recommend. It's not just a figure that we put out as a fair value. We take a lot of to arrive at that figure. There's a lot of effort that goes into a lot of processes that we rely on. So it's a very important message that needs to go out to the investors. So with that, we would like to wind up today's session. We would like to thank all the investors for participating, for joining us today. And thank you, Divya and Hasita, for those lovely presentations and the insightful clarifications you all did for us. Thank you.
Thank you very much, Divya and Hasita. Since there are no further questions, I would now like to close the webinar. We want to keep our webinars concise and relevant, but we assure you we will be back soon. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you to our staff who helped to organize this webinar, and for our valued clients for your participation. Hope to see you soon at our next webinar. Thank you very much.